JSE Safex style options, a great choice.
Welcome back to Wealth and Wisdom. Tonight our guest is Mike Brown of ETF SA, and he's telling us about exchange traded funds, some of the benefits of this way of investing into the market, and how you as a retail investor can do that. So Mike, you mentioned just before the break that we could invest with a debit order. How does that system work?
Well, the client fills in the application form, gives us his banking details, and our administrators, we have to appoint an outside administrator in terms of FSB rules, will go to the bank and just deduct that amount from his account end of every month, 300 Rand, 500 Rand, whatever amount it is, and invest in whichever ETFs the client chooses.
Okay.
So we'll do that investment for the client. We'll reinvest the clients. The ETFs pay 4 dividends a year. We'll reinvest the dividends for the client because a lot of your performance comes from just reinvesting dividends, or we'll pay the dividends into the bank account of the client. So we do all the administration. So effectively, when I say we, ETF SA and its administrators will act as a back office of a stockbroker, but we'll look after smaller clients as well as big clients.
So is there a sort of any tax advantage to reinvesting the dividends or to not reinvesting them? I mean,
not really from a tax point of view, because nowadays you have a withholding tax on dividends, so your tax gets deducted before the dividends get paid. We then reinvest the dividends after tax. What we will do is we'll send the client a tax certificate at the end of the year.
Dividend withholding tax.
Dividend withholding
tax. 15%.
That's right.
And then
the other 85% gets then reinvested. The big advantage of reinvesting all the time is that you're capitalizing your dividends, and therefore that capital grows a bit more strongly.
Is it 10% or 15?
15 is the withholding tax and
the
dividends.
Dividend withholding tax.
Yeah.
And then you get sort of, so if they pay out 1 Rand, you get 90 cents, 85 cents, and the guys will then reinvest that at ETF SA into the same ETF for you.
Yeah.
Now, with a debit structure, is there a benefit to saving up your money and hoping for a time the market's a little bit lower and you can put your money in, or should you just have a debit structure? Is it just that discipline that people find easier? I mean,
the research indicates that averaging out by buying shares every month at whatever price they are at the end of the month actually outperforms a buy and hold strategy over periods up to about 5 years or so. It's only after that perhaps, because the market's increased so much, it doesn't really matter when you first started. But averaging out's a great idea. Number one, for performance, and secondly, because you can afford to put a couple of bucks away every month, and you're buying shares every month, and of course that's growing over time. So it's accumulating, your investment accumulates over time.
So then you sort of have that average sort of entry level price, which is probably more advantageous than maybe you at home trying to pick the market, unless you really
unless you buy at the very bottom and sell at the very top.
So if you buy in March 09, everyone looks like a hero, but there weren't that many people with money around and the guts to do it at the time, which is why the prices were so low. So
but if you had a debit order, then you were buying shares at March 2009.
You were buying shares in March 2009, which is quite interesting because other guys weren't. So you're buying all that way. You've probably done quite a bit better on that than if you just sort of had a lump sum and waiting, and you'd be panicking with everyone else then, and you wouldn't actually get the exposure.
No, we look at our client accounts. Amazing how much money people make by just sitting there for 4 or 5 years and just putting money away into. And a lot of these ETFs have performed very well. They've given you 20-30% per annum over the last 5 years or more. I mean,
that's pretty amazing. I mean, an ETF. The South African market has outperformed a lot of its global peers. I mean, in the same period that the Dow and the FTSE have just been sort of stagnating for 10 years, we've had a great bull run from about 2002 till 2007, 2008. We had this fantastic bull run in stocks, and that was a great place to have your money, was in ETFs.
The other thing with ETFs is they give you exposure to lots of asset classes. So you could have bought an ETF in gold, new gold, and the gold price has shot the lights out over the last 5 years. Or you could buy a property ETF, which just invests in property shares. Now, property shares have outperformed the stock market, JSE all share buy significantly over the last period. Or industrial shares, which have done very well. Or you can buy an ETF which just invests in shares that pay high dividends, the Satrix Divi. And investment theory worldwide says if you're going to buy any portfolio, buy a portfolio of companies that pay good dividends. Now you can buy an ETF that just buys companies that pay good dividends.
And so you've had all types of. How's the Satrix Divi performed relative to, say, the Satrix Top 40?
It's outperformed the Top 40. It's underperformed the India a little bit, but not by much. But that's the price of Satrix Divi is more or less doubled in the last 3 years. That's a very good performance. So you can buy an ETF, or you can buy a mixture of ETFs, and that's typically what a lot of people do. They buy 4 or 5 different ETFs across different asset classes. But you can buy an ETF in bonds, you can buy an ETF in property, you can buy an ETF in commodities, you can buy an ETF for foreign markets. So that's another
benefit of ETFs, is that you can get access to stuff you probably couldn't otherwise in quite a low-cost, simple format without paying big active management fees. So you can go and buy bonds, but I mean, the bond market we're talking about a standard sort of trade size is more than R1 million. So if you're not bombing around with that much cash, then you can get exposure to the bond market through an ETF.
Yeah,
what are some of those bond ETFs that are out there?
Well, you've got the Z-Govy, which invests in government bonds, or you've got inflation-linked bonds. RMB, Rand Merchant Bank, has got an inflation-linked ETF, which is fantastic.
The BIPS ETF.
BIPS ETF. Okay. So it goes up by, your capital goes up by the inflation rate all the time. So inflation rate 6%, your capital value will go up 6% every year. And your interest rate goes up by the inflation rate as well. So you're linked to inflation. So your money's always protected against inflation. So for a long-term investor, to be able to buy inflation-linked bonds is fantastic, because up until now, all the inflation-linked bonds are bought by long-term pension funds. Because they're looking at protecting liabilities in 20, 30 years' time. They've got to pay you and me a pension in 20, 30 years' time. As a small man, you haven't been able to invest in inflation-linked bonds, but you can do it through an ETF. You can put 300 Rand a month into a
300 Rand per month
into an inflation-linked bond.
Stuff that you couldn't get as a retail investor. So that's another one of the benefits.
It's creating access. It
creates access to different products.
That's quite
so. Thanks so much for watching Wealth and Wisdom tonight. Thanks so much for being with us, Mike.
It's a pleasure.
Fascinating set of products and some very interesting opportunities and a low-cost way of getting access to the market, to a whole basket of shares, one simple trade.
Thank you, James.
Thanks for being on, Mike.
Wealth and Wisdom was brought to you by the Johannesburg Stock Exchange.